Hi, this is Dawn back again, and today we're talking about reverse mortgages. Maybe you have purchased your home many years ago and you're in your home and your expenses have increased and your income has decreased and you're on a fixed income and you need some ideas to stay in your home. You'd like to stay in your home through the rest of your life into your old age, and you need some ideas. Well, one of the possible solutions is a reverse mortgage. So today we're going to talk a little bit about that. What is a reverse mortgage? What are the advantages? What are the disadvantages? And what are the facts about it? If you find this video helpful, please share it out to others that would benefit. So let's get started. Number one, you have to be 62 years old or older. So this is for basically seniors. And whoever, if you're married, your spouse also has to be 62 years or older as well. So, so all persons that are on the title, living in the home, married, have to be 62 years or older. The second thing is it has to be your primary residence. It can't be a vacation home or an investment property. This has to be your primary residence, and it's insured by FHA HUD, so the loan limit is typically limited to $420,000. That's the maximum that it can become or be. And third thing is that you have to have substantial equity in your home, because a reverse mortgage is based on three things. It's based on the equity in your home, your age, and then the interest rate that you pay over time. So let's break that down a little bit more. You will for sure still be responsible for the taxes, the insurance, any HOA dues, and upkeep of the house. So it's very important that you continue making those payments, because it is true. You can have your home taken from you by a tax foreclosure, or if you have a condo, your HOA dues can be the HOA. So it's true that your taxes, insurance, HOA dues, and the upkeep of the property have to still be paid by you. A reverse mortgage does not take over paying the taxes, the insurance, and the HOA dues. Those are your responsibility, and the upkeep of the house. The Washington Post claims that more and more people are losing their homes to a reverse mortgage foreclosure, and that is simply not the case. What happens is a person will lose their home because they're not paying their taxes and their insurance and their HOA dues, for example, and then say the government comes in and does a foreclosure. So if there is foreclosures taking place, those same foreclosures would take place regardless of the reverse mortgage or not, because the government can come back and take your home back if you're not paying the property taxes, or if you're not paying the HOA dues, the HOA management company can come in and force you to pay those or foreclose on you. So a reverse mortgage, we're going to talk more about this, is a non-recourse loan. So you do have to take a HUD counseling class by a HUD insured counselor, and the reason for that is so it gives you and your heirs a chance to sit down, ask questions. Typically, when I set up a reverse mortgage, I'll always give you some data, some information to take, some charts, and some what your options are based on your age, based on your home value, based on if you owe any money. And then you take that paperwork with you to the counseling session so that you can ask specific questions about your options as a potential borrower on this reverse mortgage. So let's do an example together. Let's say that you have a home that's valued at $300,000. And let's say that you are somewhere in your 60s and you owe $50,000 on your mortgage. You have a little mortgage balance of $50,000. Let's say that payment is $562. Well, the first thing that the reverse mortgage company will do through this reverse mortgage refinance is pay off that $50,000 loan. They pay it off completely, so you do not have that $562 payment anymore. So, as I said earlier, how much can you borrow, maybe is your next question. Well, it's based on, as I said earlier, three things. Your age, so whether you're a man or woman, life expectancy, right, goes with age, the equity in your home, and the interest rate. And typically you can borrow 45 to 65% of your value of your house, 45 to 65%. The reason why it's limited to that is because you need to maintain somewhere around 40% equity in your house, because if you're not making mortgage payments, the interest is going to accumulate. So let's go on with that example a little bit more. Let's break it down. So your value of your house is $300,000. let's say that you owe $50,000. And let's say that it's expected that you're going to receive, that you're going to be alive for 18 years. And so over the 18 years at 5% interest, you'll have owed the bank, if you use the maximum of your value of your house, $145,000 in interest. So that means that the maximum available to you is your value of your home less the interest that you will accumulate over the 18 years, which is $145,000, giving you access to about $155,000 of equity. So if you have access to $155,000, you owe $50,000, so that will get paid first, leaving you with $105,000 remaining equity. But don't forget, there are closing costs, and you have to pay what's called an insurance fee over time because this is a non-recourse loan. We'll talk about non-recourse in a minute, but you have to pay these insurance and closing costs. Let's say they total about $10,000. So now you're left with equity of about $95,000. And then you can take that equity in various ways. You could take it in an equity line of credit that just opens up for you and you can pay yourself as you need it, maybe for home improvements or to live off of, or to give your heirs some of their inheritance now. Those are all options if you want to see them receive their inheritance while you're alive. That's exciting. And the other way that you can take your payments is you could take it monthly, a stream of payments over the life of your loan. And it's all based on life expectancy. So if you outlive the life expectancy, let's say your life expectancy is 87 years old. If your life expectancy is beyond that and you live to 93 years old and you're still living in the house, those payments cannot stop. That's what that means when it says non-recourse. So a few things. Non-recourse means they cannot kick you out of your house as long as you're paying your taxes, your insurance, and you haven't been foreclosed by the government, let's say. They cannot take your home, even if you've outlived the life expectancy of your house and you're getting, let's say you're getting $400 a month in these monthly payments. You will continue to receive those payments because it's a non-recourse loan. There is an insurance policy that the mortgage company gets from the federal government insuring you. So the mortgage company provides you the loan, but HUD or FHA is your insurance backer. And so that means that the house cannot be foreclosed on you if you outlive your life expectancy, or if the value of your house goes down and your loan balance is higher than what you owe, you will not have to pay the difference back. That's where the insurance kicks in. So it's not possible that if after your death, or if at any time you choose to sell your home, let's say that you owe, so let's say in 18 years you owe $300,000, right? The anticipated, the $155,000 that you borrowed plus the $145,000 in cumulative interest. You owed $300,000. And let's say in 18 years the house value is only $250,000. Very unlikely, but let's say that it is. And there's a deficit of $50,000. Who pays that deficit? Do you have to? Do your heirs? No. The insurance policy, the federal government will write a check to the bank for $50,000 for their deficiency, because that is a non-recourse loan. You paid the insurance premiums for that type of loan so that you wouldn't have anything come back on your heirs. So in that case, your heirs would help sell the house for $250,000. HUD would write the bank a check for $50,000, and your heirs would be completely washed of it. The other thing you should know is at any time you can sell your house. So let's say that after year 10, you need to go into a nursing home or you decide to move in with your kids, you can sell that house. And you won't owe the $145,000 of anticipated accumulated interest. You're only going to owe the exact amount of accumulated interest at the time of sale. So let's say at that time of sale, it was $85,000. So you have the $50,000 that you owed, the $85,000, and say $10,000 of closing costs. So what is that total? About $125,000, let's say. And plus any money that you drew. So let's say you sell your home for $300,000. You pay off the reverse mortgage, the balance of that reverse mortgage, and then you pocket the rest of your money and you go on to your family's house or go on to your nursing home. So you don't have to stay, this loan isn't required to stay in for the rest of your life. It's only available to you for the rest of your life, and the bank cannot take your house from you as long as you're making your taxes and your insurance payments. It's also important to know that a reverse mortgage has to get set up in the beginning, and so you have to be on time with your taxes and your insurance and your HOA dues. So if you are not on time and you haven't been on time, the best thing for you to do is to wait until you have had a track record of paying those 3 things on time, because the reverse mortgage really cares about those taxes and insurance. They don't want that home foreclosed on you just as much as you don't want it foreclosed on you. That would be disastrous for them as well. So they want to make sure that you're paying, that you're able to pay the taxes, that you're able to pay the insurance, that you have a proven track record of doing that leading up to the reverse mortgage. You get the reverse mortgage and you continue to take care of the property, pay your taxes,
a reverse
pay your insurance as you go.
Is accumulation of mortgage payments, and it's based on an amortization schedule. So let's break that down just a little bit more so we have a little bit more of a base understanding. So let's say that your loan balance starts at $100,000 and your interest rate's 5%. After year 1, your loan balance will accumulate, for example, at a 5% interest to about $106,000. After year 2, $112,000. After year 3, about $119,000. So your loan balance is going up by the amount of interest. That makes sense, right? Because otherwise, you're paying out the interest. If you had a $100,000 loan, you would be paying about $6,000 a year in interest. You'd be paying $12,000 in year 2. You'd be paying about $18,000 out of pocket in year 3. So it's the opposite. It's in reverse. So you lose a little bit of equity every year that you stay in the house because it's paying the interest payments for you in reverse. So what are some pros and cons of a reverse mortgage? Well, pro number 1 is that if you have an outstanding mortgage balance, it's paid for you. Pro number 2 is that you do not have to make any future mortgage payments on your home loan into perpetuity for the rest of you and your spouse's life as long as you live in the home. Number 3, you get to enjoy a stream of payments that will live until you die. So it will continue no matter what until your death. Or you can take an equity line of credit where the line of credit is open and available to you, and that line of credit does increase as the value of your home increases. So they do anticipate a growth rate on that equity line of credit. Or you can do a combination of the two. Pay off any mortgage debt that you have, an equity line of credit open, and a stream of payments that will continue indefinitely to the rest of your life. Some cons, some negatives. There are high closing costs. The interest rate can either be fixed or adjustable, so it can either be an adjustable rate mortgage based on the economy, based on the market, the going rate, or it can be a fixed interest rate. And because of that, your heirs will not have as much equity and potentially no equity when they go to sell the property, depending on how long you lived in the house and how much interest that you paid over time, that you had to pay back over time. So depending on the number of years, if you stay in it 5 years, obviously you're going to have a lot less that you owe back to the reverse mortgage company on your payoff than if you live in the home 22 years or 28 years. So to give you an idea. So your heirs may not have equity in that home and may not have that benefit of having that equity upon your death, or they may not have much of it. They will have less. The other thing is, I think it's important that you make this decision not just with you, but with your heirs, with your kids, because they love and they care about you. And I would suggest that when you go to counseling, that you go with your parents if you're the child, and if you're the parent, have the person that's closest to you and that you trust the most, or 2 people, go with you so that they can ask questions that you may not even think of knowing. And if you call me up, what I'll do is run an analysis for you and give you that paperwork, a start off point to give you an idea, and then have you take that with you to counseling. And then after that, when you decide to proceed, we'll start with an appraisal and we'll move forward with the steps. A reverse mortgage doesn't take long to close, about 3 weeks, and it has some wonderful benefits to it and some costs to it. So it's definitely a good idea to do a benefit cost analysis to see the pros and cons of that. Thank you for watching. I'm so glad that you did. This is Dawn Connors at Mortgage One.